Welcome to Technical Tuesdays. This is Fed Razak, Senior Trading Strategist here at CMTrading. And today we're going to be discussing the most important economic data that comes out almost every month that shakes and rattles the markets. But more importantly, what specific symbols that correlate to this economic data that moves the most during these news releases. But first, before we start, make sure to like and subscribe so that you could get free educational material just like this. So let's just jump straight into it. What are the most important economic data that comes out every month? Surely that's the NFP, the non-farm payroll number that comes out from the United States. It's generally populated the first Friday of every month, and it gauges the unemployment for that previous month. So for example, if for February we came out with the NFP for the first Friday, that reflects all the unemployment for the previous month of January. Now, this is probably the first line of engagement with the market that we have some sort of gauge of whether or not the economy is expanding or detracting. Because if there is economic activity and it's increasing, that means the workforce is going to have higher demand and people are going to be less in unemployment. Now, if the markets are, or the economy is detracting, then that means people are going to be laid off and unemployment is going to go higher. So this is probably the first line of economic data that everybody really gauges to see which way the markets are really going. Now, the next most important economic data that comes out every month, and right now, this is probably the most important economic data, is the core price index, which is the CPI. CPI basically gauges the inflation or deflation of the value of money from month to month for the same goods and services. So what is inflation and what is deflation? So if you look at the same goods and services from month to month and you compare the prices month to month, if prices are increasing, that means that the goods and services are becoming more expensive and the value of money is decreasing. And as a result, things are becoming more and more expensive, and people need to make adjustments to them. Landlords need to increase rents, salaries, and employers need to increase salaries, etc., etc. So you see the ramifications of it. Now, this number has become one of the most important numbers right now because we have seen tremendous amount of inflation, not just in the United States, but around the world. And central banks, which is going to lead me to the next important economic data that comes out, are stemming and kind of tiptoeing around this number and acting as aggressively as possible. Because in terms of not having enough work, that's one problem. But having a currency that's not being stable is a much more serious issue. So central banks are going to look at this number much more importantly than they're going to look at unemployment. So that leads us to the third most important economic data that comes out every month, and that's the FOMC interest rate statement and decision. That's the interest rate decision that comes out. It comes out about 8 times a year, where the Federal Reserve, which is the central bank of the United States, comes out and populates a interest rate decision. And that number, whatever interest rate that is what the Federal Reserve will charge. The central bank charges several retail banks in the United States what they will end up charging their clients. So it's the first line of bank that basically bankrolls all the banks in the United States and lends them money. So if there's an increase in interest rates, that means money is going to be more expensive and there's going to be less supply of it. And if the interest rates are lowered, that means more money is going to be available for the market and people are going to borrow. And that's usually an area where there's an expansion in the economy. Okay, but when the money becomes more expensive because interest rates are higher and money supply is less, then that means more people are going to look to not borrow money as much because it's much more expensive to borrow that money. So the first two are really the two numbers that the Federal Reserve is looking at any given time to kind of make a decision about their interest rate decision as to which way the interest rates will go. Now, there are other means that the Federal Reserve does kind of control, not kind of, but does control the flow of money into the markets. But this is probably the most vital one. Now, the next important economic data that comes out is consumer confidence. Now, this is a number that is really gauged on several factors, but it's not a specific number, okay? Because non-farm payroll is a specific number. CPI is a specific number. Also, the FOMC interest rate statement is a specific number. Consumer confidence is just a gauge of people, general people in the market, of whether or not they're having confidence in the economy. And that affects their purchasing power, that affects their purchasing styles, and that is really a major gauge to kind of give us a direction of what the consensus is amongst the public as to which way the markets are going. And this one is really very, very important and doesn't get enough attention and is really shaking and rattles the markets. Now, all of these, okay, the number one symbol that is affected mostly is the Dow Jones Minis, because those are most related to all the unemployment, because it reflects on all the type of businesses in the United States. So that affects all type of people who are going into unemployment. The core price index is the second one, which affects the general market. And the FOMC generally affects either US banks, okay, so you could trade the banks during that time when those numbers come out, or you could check the Dow Minis because the banks are listed on that index. And consumer price index is, consumer confidence, is the same story as well. Now, the last number that is the most important economic data that comes out is when stocks populate their quarterly earnings. Now, if you're a publicly held company like Microsoft, like Facebook, like Google, any one of these companies, right? Every quarter, as a standard from the requirement of the listed stocks index. So in this case, it's the New York Stock Exchange. They require each company to publish their accounting books every quarter, every 4 months. So it becomes very transparent as to how a company did in that previous quarter in terms of sales, in terms of expenses, in terms of expenditures, in terms of whether or not wages went up or wages went down, whether or not industry manufacturing went up or it went down, or whether or not they have an increase of inventory, which means things are slowing down. So this number is also very important, and it's these tidbits. It's a little bit of numbers here and there, and they all come together and they give us a general view of what the marketplace is doing. So you have micro level and macro level. The last one is really stock specific. So if Microsoft is coming out with good earnings, I want to be trading Microsoft. There's nothing else I'm looking to trade. Now, these numbers usually come out every quarter, either before the market opens or after the market opens or closes, So this number is also kind of a variable number. It doesn't come out every single month, but it does come out every quarter, and it does shake and rattle the markets, especially if it's a major corporation that is warning that they're going to miss their targets or that they're not going to hit their targets next quarter. That information is very, very vital. So these are the most important economic data that you can trade either during or after, and the symbols that you could trade them with. Thank you for joining us for Technical Tuesdays. We'll see you here next time.